Hello Archers. Now that we've kind of gotten through all the nuances of all the details of how different types of life insurance work, permanent life insurance, I'm going to start breaking down how each individual permanent life insurance works, how the premiums work versus the cash value and the amount of life insurance and the effects it has on it. Check out my webpage at AFC0008.com. So we're going to go back to the example that I had several videos ago where we talked about annual and target premiums. So we have a 25-year-old who has a $100,000 life insurance policy, and their annual premium is $100 a month, and their target premium is $500 a month. So over here, this is going to be our premium side, and then down here is going to be our age. All right, so we're going to start at age 0 over here, go 20, 40, 60, 80, and then 100. The example that I gave for this 25-year-old is that we're going to start our premium, our annual premium at $100. So we're gonna start our insurance at $100 here, and our maximum target premium is $500. And to start with, we're going to use green to represent what the insurance would look like if we were just making our annual premium for the life of the policy. So this person is 25 years old, so we'll start this about right here. This is the life insurance policy he took out for the rest of his life. Okay, he's going to make a fixed premium, annual premium. The $100,000 life insurance is going to stay the same. Okay, this is life insurance. Now, we're going to use this part up here to represent the cash value. Okay, so we're going to represent our annual premium cash value in orange. Now the cash value, when the policy first starts, is going to have a small dip usually. This small dip right here is due to the first year or two paying off the life insurance, and then it's going to steadily start climbing over the life of the policy. And this is not to scale, this is just to give you an example of what the life insurance policy is going to do during the life of the policy. So this is the $100 a month annual premium. Okay, now let's say when we put the policy together that this person decided that they were going to pay $300 a month total, an extra $200 a month against the target premium. Well, because this is whole life insurance, we're going to use our paid up additions to add to our policy. Okay, so if you remember back to the video that I did on annual and target premiums, paid up additions, you're buying a small amount of life insurance, and you're also putting the majority of it into the cash value. Okay, so what that means is that your life insurance policy is going to gain in value over its life. Okay, so instead of it being $100,000, it's going to start climbing slowly like this, because you're using a small part of your paid up additions to buy a little bit more life insurance. Now, the second part of this equation is that your your cash value, instead of having this little dip, there may be a little tiny one in the very beginning, little itty bitty one, but it's going to start climbing a lot faster as a result of you putting more money into the cash value. So this is at like a $300 a month target premium. So that's really basically how whole life insurance grows money. You can also grow your life insurance during the life of the policy as well. What's nice about whole life insurance is that it's going to pay dividends. Okay, your cash value pays dividends annually. And that's based on the profitability of the profit of the insurance company. So every year they're going to look at your cash value and they're going to pay you a percentage of dividends. Historically, it's been about 3 to 6%, depending on the insurance company. Those dividends are reinvested back into your cash value and increases the cash value over time. Whole life insurance is probably the simplest, the least complex of the permanent life insurance, the 4 types. Also, it is what we call a buffer asset as well. You can use whole life insurance to diversify your insurance portfolio to offset the market losses that you may incur in index universal life or variable universal life. So you can partner a whole life policy with a IUL or a VUL in order to help offset any losses you may incur in a year or two. That's very important when you get up into your retirement years after age 65, because you may want to use your permanent life insurance as a substitute to your retirement planning, because once you get up in here, this extra money that you're making in your whole life policy can be used to pay for everyday expenses if the markets are down in your IRA or your VUL or IUL. And it's a little bit more complex. This is a little bit more complex financial planning, but I want to kind of start talking about this because I want to start talking about diversifying and using these type of life insurances to not only offset retirement planning, but also offset, your emergency planning. You can use this for college planning. There's a lot of different great things that you can use for whole life insurance and other types of permanent life insurance. But we're going to start getting into more complex ways that you can use this for yourself. So I'm gonna end the video here. I just want to ask you a question. Are you taking advantage of your target premium in your whole life policy, or are you interested in talking to me about how whole life may be a good alternative for you for your retirement planning or for your emergency savings or college planning as well? So, thank you.